The top business stories live from the Sky News City studio. Inflation falls to 3.4%, a bigger than expected drop, with food prices the main driver. We'll have all the reaction and assess what it means for the timing of possible interest rate cuts this year. Plus, I'll be joined by the Chief Executive of the David Lloyd leisure fitness chain to hear about its investment plans. Good morning, this is Business Live with me, Ian King. Our big story this morning is, of course, inflation, which has fallen by more than expected. The Office for National Statistics says the Consumer Prices Index measure of inflation stood at 3.4% in February. That was down from 4% in January, and it's the lowest level since September 2021. It was driven largely by a fall in annual food price inflation, which came down to 5% in February from 7% in January. Well, with inflation now at its lowest level in more than 2 years, the Chancellor, Jeremy Hunt, says it could hit the Bank of England's target rate of 2% within months.
Families today will heave a sigh of relief that we are firmly on track to bring inflation down to its target 2%. This is the lowest headline rate for 2.5 years, but most encouragingly, food inflation, which was nearly 20% a year ago, is now just 5%. And what this shows is that the plan to bring inflation down, it was over 11% when Rishi Sunak became Prime Minister, now just 3.4%. That plan is working, but we do need to stick to it and see it right the way through.
Well, with me now is Victoria Clarke. She's UK Chief Economist at Santander Corporate and Investment Banking. Victoria, good to see you this morning. Numbers slightly below expectations. Any surprises in the data for you?
A little bit of a surprise. I mean, look, furniture was a little bit softer than we'd expected. But in the main, I think that, the numbers are doing what we and I think most of the city expected them to do. Fairly broad-based declines, food prices leading the charge as expected, but it does look as if, having had some very strong increases in prices a year ago, we're just struggling to match up to those, and that's helping to bring headline numbers down. I think we'll see much more of that over the next few months.
Yeah, so this is what economists call in the jargon base effects.
It is, it's the base effects, exactly.
Food, quite interesting there to notice some of the declines in particular. But it's worth pointing out that core inflation, which is energy, food, alcohol and tobacco, is still appreciably ahead of the bank's target rate. Presumably this is why they won't be rushing to cut interest rates tomorrow. Yeah,
so the core inflation, if you take out food, energy, the bits that typically jump around month to month, that is higher. And one really big focus for the Bank of England has been the services CPI numbers, which are still, with the 6 handle, 6.1%. Yeah. And that was a little bit above where most people had expected it. So I think those services numbers are actually the main reason that the Bank of England's not rushing in. It basically did what the Bank of England expected, came down. But 6 is a big number for year-on-year services inflation. And with that, it can't say, look, I know for sure that inflation is going to stay down at 2%, even if it gets there soon.
Absolutely. And services inflation being driven in no small part by wages. I mean, wages inflation is still pretty high, and particularly in some of the services sectors.
Yes, so wage inflation is still high, again, compared to a year ago. What some of us have been trying to do is work out what the more recent trend is. And I think if you look at the private sector and you take out the base effects, the effects from a year ago, beneath the surface, pay is looking a bit more promising in the Bank of England's eyes. The Bank of England's looking to see that it gets a more 2% inflation goal consistent level. So it's going the right way for the bank. But there's a national living wage increase that takes effect in April, and that's a big focus for them. And if we see that do what it did last year, it could lift pay growth and inflation, and that might, in the Bank of England's eyes, just make it be a bit more cautious.
That's very interesting, because everyone's assuming that come April we get the reduction in the energy price cap, and that is going to bring the target inflation down to near the target rate. But that rise in the living wage might act against that.
It's certainly a risk. So we're seeing already actually announcements of the living wage increase, and the question is not, we know that national living wage increase is nearly 10%, but how does that play out across the jobs market? Yeah. If you're looking at supermarkets, retailers, the wage spectrum can be quite compressed, and you might see that broaden out, and that's the thing they're watching. And then the second part is, well, look, how much of that passes through into prices. So this is really important, and this is one of the reasons why, even if we get some lower inflation prints. The Bank of England just doesn't want to rush in. It wants to make sure that it's definitely getting the job done.
In the meantime, it's worth reminding people, I guess, wage inflation is now running at considerably higher rates than the headline rate of inflation. Would you expect that to translate into stronger consumer spending, for example?
Yeah, I think this year looks a lot better for households than last year did. So, yeah, dropping inflation, pay growth still relatively high. And, there are signs in a number of segments of the economy that it's doing a little bit better this year. And I think the drop in inflation and the impact that that has on, your spending power is important. So, yeah, this is definitely a relevant thing for the Bank of England. And, whilst the economy is doing okay, doing well enough, it's not seeing super strong growth, but we're probably seeing some growth again. I think that just allows them to take their time and wait until summer before they start any cutting cycles. So it is all going the way that I think that they would like it to go. Economy does fine, inflation comes down, pay seems to be moving towards more inflation goal consistent levels.
Yeah, now obviously the MPC meets tomorrow. We had a three-way split last time around. Would you expect to see that again tomorrow?
Yeah, I think that we will get another three-way split. So we've got one clear dove who's pretty keen to see cuts. That's Stingerer. We've got most of the Monetary Policy Committee. That's the governors, the deputy governors, all grouping together, quite happy to sit on the top of what they're calling Table Mountain and see, what all the data does. And then at the hawkish end, there were two last month. Catherine Mann's a well-known hawk. And there was Jonathan Haskell. And we think Jonathan Haskell's looking at the way the labour market's looking a bit softer and pay growth and thinking, OK, I can sit with that middle group. And then if they do get to the point of cuts in the summer, he's moved in that direction. He also looks a little bit more like, he's in the group. And we think he's one of the people who'll be quite responsive to data. So it moves him along, brings him into the pack. So that'll be a three-way split, but I think definitely an MPC, which is a bit more comfortable with what's going on in the numbers. OK, and very briefly, Victoria, the market's now putting a 63% probability of a first rate cut in June. Do you go along with that? I think it's a really tough call. So our base case is that the first cut comes in August. Right. But the data is, it is making things more possible for a June cut. So I will be sat at my desk thinking that June is super live on the day of that meeting if the data continues to go this way. Absolutely. Victoria, got to leave it there. Great to see you as ever. Thanks for joining me today. And there's much more inflation analysis on the Sky News Money blog. If you scan the QR code on your screen right now, you can go to that. Bit of breaking news to bring you. The union ASLEF has announced that train drivers at 16 rail companies are to stage a fresh wave of strikes and a 6-day overtime ban in a long-running dispute over pay, threatening more travel chaos for passengers across the country. More on that throughout the morning here on Sky News. In the meantime, some other business news stories for you. And the materials and sustainable technologies group Johnson Matthey is selling its medical device components business to Montague Private Equity for £550 million. The unit, which has manufacturing sites in the United States, Mexico and Australia, provides components based on focus on precious metal alloys and nitinol, which is a metal alloy of nickel and titanium. Well, JM said the sale brings to an end the divestment programme it began in May 2022, in which controversially included the sale of its high-performance electric car battery business. Some £250 million worth of the sales proceeds will be returned to shareholders, and shares of JM have risen this morning by 8%. Hornby, the Model Railways Group, said this morning that the entrepreneur Mike Ashley had entered a consultancy agreement with it. The company, which also owns brands such as Airfix, Corgi, Scalextric and Humbrol, said Mr Ashley would be available to support Ollie Rayburn, its chief executive, and the wider business on systems, operations, logistics and, where relevant, broader matters of strategy. Well, the news comes weeks after Fraser's Group, in which Mr Ashley is, of course, the majority shareholder, disclosed it had taken an 8.9% stake in Hornby. The FTSE 100 insurer Prudential this morning hailed the return of mainland Chinese visitors to Hong Kong for boosting life insurance policy sales and helping it return to profitability. The Pru, which has spun off its UK and US operations in recent years to focus on Asia and Africa, was reporting a full-year profit after tax of $1.7 billion for 2023. That was up from a loss of $1 billion in 2022. Apart from a surge of buying by visitors to Hong Kong from mainland China, the Pru also highlighted big increases in policy sales in Indonesia, the Philippines, Malaysia and Singapore.
Well, the pound has fallen slightly against the US dollar on the inflation data this morning. Sterling currently off just over 1/5 against the greenback, although that partly reflects dollar strength ahead of tonight's decision from the US Federal Reserve. As you can see, pound more or less unchanged against the euro. On the equity markets, well, last night's gains on Wall Street were followed by a largely positive session overnight in the Asia-Pacific region. The Nikkei enjoyed another solid gain as the yen fell to a 4-month low. Well, in Europe, stocks have been a little bit more mixed this morning. Only the DAX in positive territory right now on mainland Europe. The big story by far this morning is Kering. The French luxury goods group is currently off 14% in Paris, and that's after it warned that Gucci sales will be down by some 20% in the first 3 months of the year. Well, here in London, the FTSE 100 is largely in mixed territory this morning. I think we can show you the FTSE. Any second now. It's off about 0.1%, I can tell you that. In terms of the features, well, Burberry is among leading fallers. That's off in sympathy with Kering. There are one or two gainers to mention. The big fall there, the Pru. Just mentioned their results there. Slightly mystified that. The shares were up first thing. They're off 6.5% right now. To the upside, the Health, Safety and Environmental Services Group, Halma, a regular on this programme, benefiting from positive broker comment today and currently up 3.5%. Outside the FTSE, Close Brothers is up another 9%. Mentioned them this time yesterday. Trading update went down very well. That's continuing to win support today. While Johnson Matthey, which I just mentioned, up some 8% right now on that return of capital to shareholders. 8.25% now, in fact. To the downside, the Technology Services Group Computer Centre is off 8% despite reporting record results. As for the oil price, well, that's given back some of yesterday's gains. A barrel of Brent crude is currently changing hands at $86.65 a barrel. That's up a little over off a little over 4/5 of 1% on the session. Well, joining me this morning is Laura Foll, Equity Income Fund Manager at Janus, Henderson. Laura, good to see you this morning. Market hasn't really budged much on the inflation data, has it?
No, I mean, I think we've got to put it in the context that we're arguing here about 0.1%. The expectation was 3.5 and it's coming at 3.4. So the reality is it's not too far away from that, and markets are always forward-looking, so they've effectively already priced in the data that we saw this morning.
Well, obviously, another thing that markets are trying to look forward to and gauge is the possibility of a Labour government. We had this big set-piece speech from Rachel Reeves last night. What did you make of what she had to say?
Yeah, so this is all part of setting the scene in the city for a possible upcoming Labour government. And the main news that I took from it is she set herself a fiscal framework that, on the face of it, doesn't sound too different from the current fiscal framework that we've got. The main change being that she seems to be separating capital expenditure, so big, for example, infrastructure projects, from the number being the aim is to bring down public sector debt as a percentage of GDP 5 years out. Now, clearly, there's a lot of moving parts in that forecast. You have to forecast both the debt and also GDP. And even 1 year out, that's relatively difficult to forecast. So 5 years out possibly gives you some stretch on it. But nevertheless, you're setting yourself some fairly tight fiscal guidelines.
You really, I mean, the funny thing is, I spoke to the head of the OBR on budget day and said, how do you feel about all of these forecasts being set on where you think the debt is going to be 5 years from now? I mean, it's really like trying to hit a dart on a dartboard.
To me, it's not. This is my view. I don't think it's logical. You're trying to estimate things that are very difficult to estimate. Under the current government's assumptions, you're assuming pretty steep real terms cuts to public expenditure, and I think it remains to be seen whether that is achievable or not. But that is what you're basing day-to-day current decision-making on. So it's having real-term effects on current day-to-day tax and spend. Is that the most logical way to go about things? Possibly not. But it seems that is being extended, whether it's Labour or Conservatives. Yeah.
Do you think Rachel Reeves is dipping into the sort of Gordon Brown playbook? I mean, he stuck to the Tory spending policies in 1997, which even Ken Clarke, the outgoing Chancellor, said he wouldn't have kept to. This is obviously the game plan.
That's exactly how it feels to me. And I think there's still a lot of fear because it's not that long since the trust budget where we saw the reaction of the gilt markets, etc. It feels to me like there is a real, for want of a better word, conservatism to how both sides are setting their fiscal framework.
Yeah, worth pointing out that the unions are not very happy about this. Sharon Graham from the Unite Union put out an absolutely stinging response, basically saying Rachel Reeves needs to be more imaginative.
In a way, I have some sympathy with that because I think, from an economics point of view, we can see very clearly that the UK has underinvested in capital expenditure in particular, and we have a productivity problem. And in the UK that's been widely discussed, and I think it really needs addressing. But you need to have a long-term time horizon if you're going to make those kinds of decisions. So rather than focusing on the sort of minutiae of what might happen 5 years from now, maybe it would be more logical to give yourself a bit more flexibility to make those decisions, those tough decisions today, but that might pay off in 5, 10 years down the line.
Now, on the stocks front, Kering, the big story in Europe this morning, what's gone wrong for them? It's all about Gucci.
It's all about Gucci for Kering. I think for luxury goods generally, Chinese consumers are just not out there spending in the way that they've been for the last decade or so. Time until recently, on the back of Chinese consumption really moving upwards meaningfully, and now it's withdrawing. And the question is, for not just Kering and Gucci, but also the likes of Burberry, is this a permanent retraction of the Chinese consumer? Or is it just that it's a tough time for their economy right now, consumer confidence is weak in China, and it will come back? And this is the real debate that luxury goods analysts and the luxury goods sector is having. Is this temporary or is it structural?
Absolutely. Laura, got to leave it there. Thanks for joining me today. Good to see you again. A few more stories for you now. And the aviation regulator said today it could impose further cuts to the fees charged by Heathrow Airport next year and in 2026. Well, in March last year, the Civil Aviation Authority said it would cap Heathrow's landing fees per passenger at £25.43 this year, at £25.24 next year, and at £25.28 in 2026. However, launching a 6 weeks consultation today, the CAA said it was proposing cutting those fees by £1.52 next year and by £1.58 in 2026. Aldi has been reprimanded by the advertising industry regulator for misleading consumers. The Advertising Standards Authority said Aldi's claim in newspaper advertisements calling itself the home of Britain's cheapest Christmas dinner was misleading in a number of ways, including relying on a comparison by Which that had been made in November and which was likely to be out of date by the time consumers actually bought items for their Christmas dinner. Well, the ASA, which was responding to a complaint from Sainsbury's, has told Aldi to ensure future price comparisons with its competitors are not misleading. Greg says it's now resolved the technical issue that prevented the chain from accepting payments, forcing some outlets to close earlier this morning. It follows a week of IT issues hitting high-profile stores, with similar problems occurring at McDonald's, Sainsbury's and Tesco. Well, joining me to talk about this is our technology correspondent, Archie Natchiap. And Archie, is this all just a bit of a coincidence?
It does seem like it, in the sense that we haven't really got information from any of these companies to suggest that any of the instances were related, or indeed much detail on exactly what went wrong. McDonald's did say that it was due to a configuration fault that a lot of their restaurants were not able to serve people on Friday. And Sainsbury's has also said that it was because of a software update that they weren't able to honour a lot of deliveries made over the weekend. Tesco also had an unrelated fault. Greggs hasn't given us a lot of detail on what happened this morning, although they have put out a statement to say that most of their shops are now accepting payments and are back open, and they're expecting the issue to be fully resolved quickly. I think the interesting thing is here, McDonald's was really particular to rule out a cyber attack. And I think a lot of companies are really worried about seeming in any way associated with the fact that they could be vulnerable in terms of their data, or could be open to hackers, because there's an increasing amount of literacy among consumers. People are really worried about their data, especially if they're making deliveries or handing over any of their personal data to these companies. And if they were to be attacked by some kind of malicious actor, there was always the sense that it could undermine trust. And they're really careful about ruling that out. But the reality is that cyber attacks are on the horizon, and they are one of the biggest threats facing companies. There's new findings out from the government this morning, actually. Got them in front of me. The majority of larger UK businesses have fallen victim to a cybersecurity incident in the last 12 months. Again, I have to stress that we haven't got any information to suggest that that was the case here. But I think what's really interesting in the company's responses is the fact that they've been as quick as possible to suggest that that was not something that they're susceptible to whatsoever.
Very good. Thanks, Artie. Still to come on Business Live, I'll be joined by the Chief Executive of the David Lloyd leisure fitness chain to hear about its investment plan. Stay with us.
Well, I think we all know that there's a need with an aging population and a growing number of people, not just with dementia, but also with other frailties that mean that they stay at home most of the time, to make sure that they have the support that they need. And at the moment, that's primarily delivered by people visiting and spending a small amount of time with them. With robotics, you've got the opportunity to give people a companion 24/7. In situations where they're not able to, for example, have a cat or a dog and look after a cat or dog properly, then giving them some form of robotic companion replaces that emotional companion and that friend in the home that they otherwise wouldn't have. But I think if the choice is between no human and a robotic companion, then a robotic companion is better than no human at all. And I think for a lot of people, they spend an awful lot of time in isolation, either because of mental or physical frailty. Making sure that they have some kind of companionship can only be good for their mental health and probably takes the burden off the health services as well. We're working on a number of different areas, everything from agriculture to manufacturing, space, healthcare, social care. We're working on offshore energy, we're working on nuclear energy. Robotics is pretty ubiquitous now and being explored by many sectors of our economy as a tool to help achieve the kind of things that we want to achieve, whether that's replacement or augmenting the workforce and making sure that we've got people where there's labour shortages, or whether it's doing work in dangerous and difficult areas. They're becoming very common now. So there are many manufacturers around the world now that have four-legged robotics. It's better balanced than two legs, but it's able to go into areas that tracks and wheels and other kinds of locomotion can't.
This is the game changer seat. Look, it even comes with binoculars. Fly Emirates, fly better. Thank you.
Welcome back. Bit of breaking news to bring you. The Chancellor, Jeremy Hunt, has intervened to stop HMRC's customer service helplines from closing between April and September of this year. We are expecting an urgent question on this in the House of Commons at 12:30 today. We will, of course, bring you that live on Sky News. Now, the David Lloyd leisure fitness chain is to invest in 12 new spa retreats this year, taking the total to 40. The upmarket health and wellness group, which is owned by the private equity firm TDR Capital, also plans to tap into the growing popularity of new racket sports with the installation of 15 new paddle courts and 7 dedicated pickleball courts. The business, which now has 750,000 members across the UK and continental Europe, said it had a record 52 million member visits in 2023. That was up 10 million on the previous year. Well, with me now to talk about this is the Chief Executive of David Lloyd Leisure, Russell Barnes. Russell, good to see you this morning.
Hi.
What sort of payback will you get on these?
More importantly, it's the demand. The one thing that we've seen happen actually over the last few years is the usage, the demand for the facilities that we offer, which go well beyond gyms, but into spas, racket sports, restaurants. We've seen that demand, as you said earlier, 42 million visits to 52 million in 1 year, with 13% up this year on last year's visits. So the demand for these facilities is exceeding all our expectations.
And that's a notable change in behaviour post-lockdown.
Oh, massive change in behaviour. I think there's two changes that are significant. The first one is our members are using the clubs more. That's great for us. That's what we want. We want to encourage that. But the second one is it's about wellness as well as fitness. We'll have 40 spa retreats by the end of this year. We believe that over half the estate can have spa retreats. Now, these are, typically extensions on the club. They have 5 to 7 experience rooms, Himalayan salt saunas, etc. That is all about wellness, all about taking care of one's mental health.
Now,
and that is a change.
You're up to 133 clubs now, I think 103 in the UK and 30 in mainland Europe. I mean, how many more do you think the market can take?
Well, we think that the UK, there's another 100 sites in the UK that is possible. And it's not to say that we'd go to 200 clubs within the UK, but there's 100 white space opportunities in the UK. If you look at just Germany and think about the German market, that's bigger than the UK. So you can see that the opportunity in Europe is vast, and we're concentrating on Germany, Italy, Spain. We've got a club in Switzerland. We believe that the brand can work across all the countries that we operate in.
Now, you've got 750,000 members. Is it possible to say what a typical member looks like these days? Is it possible to sort of generalise?
Well, actually, half our members are in family groups, so they're either children or they're part of a family. That is significant. That drives a very different type of usage to, say, a budget gym operator. That's important to us. But normally it's a family unit that's a member, is coming 2 or 3 times a week. Maybe the child is in swimming lessons. That would be a typical David Lloyd member. But, I'm proud to say that we are mass market. We will appeal across a broad spectrum of consumers.
Now, there was a lot of speculation last year that TDR Capital had put the business up for sale. Is there anything you can say on that?
There's nothing going on at this present moment in time. The one thing I could say, and this is a question for TDR, obviously not for management, but they've owned us for 11 years come this October. They're a private equity business. They've been a fantastic owner of David Lloyd. And at some point, I'm certain, they would look to realise their investment. But so far, they are incredibly supportive of our plans. OK, well, thanks for taking that one on the chin. What about pickleball and paddle? What do you put the popularity of that down to? They're the 2 fastest growing racket sports at the moment in the world. We'll have 140 paddle courts at the end of this year. We'll be the largest operator of paddle in the UK by some distance. And it's come out principally Southern Europe. Pickleball has emerged mainly from the US. And we've put pickleball now into most of our clubs. Both of them are a beautiful sport to play because it's actually a leveller of ability. So unlike tennis, where you normally have to play someone of a similar ability, with pickleball and paddle, you don't. And they're incredibly social. Fantastic sports. And I just see their growth continuing through many years. OK. I mean, I struggle to tell the difference, I must admit. Oh, Russell, we've got to leave it there, I'm afraid. Good to see you this morning. Thanks for joining me. Just some breaking news to bring you. It is being reported that the Irish Prime Minister, Leo Varadkar, is set to resign, not only as Prime Minister, but also as leader of Fine Gael. We are expecting a news conference any moment now. We will be bringing that to you. Don't go away.